Today I want to talk about how BlackRock may have been creating synthetics and helping these shorts the entire time, but how it's not really gone too well for BlackRock and how the entire market is crashing as a result. So stay tuned and let's make some money. And now I'll dive straight in with the key information. So, Fox Business has reported about Larry Fink being roasted by the former chief executive. He said that Larry Fink should resign or be fired as the CEO of BlackRock because his conduct at the very least was hypocritical and unethical, and he may have violated the law. This article is titled BlackRock CEO Larry Fink is roasted by the former chief exec over ethical investing. Stop ducking the fight or resign. And the BlackRock former sustainable investing czar Tariq Fancy called his former boss an emperor with no clothes. This surely suggests that Larry Fink is out there swimming naked or is investing naked and is about to be exposed and uncovered. It's very interesting how Warren Buffett believes that many investment managers are heavily overleveraged and swimming naked, aka creating synthetic shares. And the former head of sustainable investing at BlackRock believes his boss is an emperor with no clothes. This to me suggests that BlackRock may have been creating synthetic AMC and GameStop shares the entire time and is about to be uncovered and exposed for their significantly overleveraged positions. It would make sense that we thought BlackRock was on our side the entire time, buying up a huge portion of the AMC stock. But it makes sense that BlackRock was actually lending out these shares to hedge funds and likely working with Citadel to create synthetic shares and providing false locates. Because BlackRock actually held a significant portion of AMC shares, they were obviously allowing Citadel to locate their shares over and over and over again and lend them out multiple times. This way, BlackRock's Larry Fink was an emperor with no clothes, lending out synthetic shares and lending out fake AMC shares to the entire hedge fund market. And it says that Fancy's comments came just days after the North Carolina State Treasurer Dale Fowle fired off a letter to BlackRock's board of directors, also demanding that Fink step down as CEO of BlackRock. And he said that Larry Fink should resign or be fired as the CEO of BlackRock because his conduct is at the very least hypocritical and unethical, and he may have violated the law, he said, adding that Fink violated his responsibility to invest exclusively for the financial benefit of the beneficiaries, and not just for political gain. aka Larry Fink and BlackRock are supposed to be investing on behalf of investors and helping to generate investors' money, not by taking significantly overleveraged short positions on meme stocks for political gain. And Governor Ron DeSantis and Governor Greg Abbott have both opposed BlackRock publicly. DeSantis was praised for withdrawing $2 billion in assets from BlackRock, with one commentator calling ESG investing an illegal leftist scam. And he said that using Florida's cash fund to fund BlackRock's social engineering project isn't something we signed up for. So it seems that right now BlackRock is currently in a lot of hot water. And you'll remember from my video the other day that right now BlackRock is currently down around 25% in all of its portfolios. BlackRock so far this year has lost over $2 trillion of investors' money. And as a result, the wider market is crashing as BlackRock is having to dump assets to support their overleveraged short position. And as Seth Balsakis tweeted, he said a market crash is very much needed for the mother of all short squeezes to happen. Blue chips aren't done bleeding yet. He said Apple and Tesla still have a long way to fall. He said, remember, most of these mega caps were wealth havens for big money and not a reflection of true value. This is all needed and also a direct result of apes. That's why when many people ask, saying, Tom, why haven't AMC and GameStop squeezed yet? You said they'd squeeze when the market crashed. But my answer always is that the market has not yet finished crashing. We know that blue chips haven't finished crashing, Apple and Tesla still have a long ways to fall, and many other stocks in the S&P 500 still have to fall further as well. Yes, I believe that AMC and GameStop will squeeze when the market crashes, but as I said, the market has not yet finished crashing. We're only on, say, the second leg down out of a potential 4 or 5 legs down in total. Also, if you haven't already, be sure to sign up to Moomoo right now using the link in the description below. You can currently get 20 free shares worth up to $2,000 each, which is a whopping total of up to $40,000 in free shares. And on top of that, for the Christmas period, Moomoo is currently holding a $60,000 giveaway sweepstake. But I do believe the Japan margin call, as I spoke about this morning, could be the start, the kickstarter or the catalyst for the third leg down of the overall market crash. As Gavin tweeted, he said somebody big is getting margin call on Tesla right now. We've obviously seen Tesla and the S&P 500 falling significantly over the last week, and Gavin believes that a big fund right now is being margin called on Tesla. And as Lit Exchange tweeted, he said BMO Harris was already margin called and had to sell shares to meet their new margin requirements. He said the Bank of Montreal completed an offering of common shares at $2.4 billion, including full exercise of over-allotted options on public offerings. BMO Harris or the Bank of Montreal just sold an additional 20 million shares at 118 Canadian dollars per share to obviously meet these margin requirements. And Lit Exchange tweeted saying that all Canadian banks were margin called per se as the stability requirements, aka cash on hand requirements, were increased by the government, and he believes that a liquidity crisis is looming. So it seems that it's not just Credit Suisse and Deutsche Bank struggling to meet these margin calls as a result of these new increased margin requirements. Many other European banks and also Canadian banks are clearly struggling to meet these new margin requirements. Obviously, as a result of the wider market crashing, many of these banks are running out of cash on hand, especially with the increase in investor withdrawals, and therefore they're struggling to meet these margin requirements, and they're having to take on external loans or even sell equity and sell shares. These banks obviously aren't getting new investments from new investors, and therefore the only way they can increase their cash reserves is either to sell more equity, take in external loans, or sell off even more stocks, crashing the market further. Obviously, the alternative and better idea for these hedge funds would be to reduce their overleveraged short positions and close out them properly. But obviously, I guess they know that if they tried to close out of their short positions, they'd have to buy back hundreds of millions, if not billions of AMC shares, causing the squeeze. And on top of that, it even seems some of the biggest banks, the largest banks like Goldman Sachs, are also struggling as well. Bloomberg Wealth tweeted saying that Goldman Sachs plans to cut as many as 4,000 jobs as it struggles to reach profitability targets. The article says that Goldman Sachs plans to cut as many as 4,000 jobs as it struggles to reach its profitability targets. The cuts may amount to up to 8% of the entire bank's workforce. Managers have been asked to identify low performers, but no final list has yet been drawn up. Clearly right now Goldman Sachs is struggling, but again it's not just Goldman Sachs, because as WatcherGuru tweeted, he said just in, Amazon becomes the first company in existence to lose $1 trillion in market value, the biggest loss in history. Many of these major blue chip stocks are down 30, 40 or 50%, some down even more, but yet the market crash has not yet finished. Really, the market crash hasn't even started. And ultimately that is why, as Bleeding tweeted, he said they want you to sell your shares so they can cover as low as possible. He said that's why they've been obliterating the price for months, flushing it down as much as possible. Meanwhile, people are complaining the mother of all short squeezes hasn't yet happened and Adam Aaron has not yet triggered the squeeze. We said last year this is exactly what the hedge funds want us to do. The hedge funds want us to sell right now when the stocks are at all-time lows, and they want us to doubt the mother of all short squeezes, and they want us to doubt the CEO, Adam Aaron. Obviously, if we do start doubting Adam Aaron, who seems very, very fixated on the plan at hand, we are only doing exactly what these hedge funds want and selling cheap so they can close out of their short positions. But as Bleeding tweeted, he said shorts need to cover for a squeeze to take place. Are you going to wait for that to happen? Because I am. He said if not, just sell and get it over with and please those hedge funds. But guys, be sure to let me know what you think down in the comments below. And as always guys, be sure to ding that notification bell because that way you'll be alerted when I upload a new video. Cheers.